We come to another part of our lecture today, which is capital structure and solvency ratios. So far, we spoke about liquidity ratios, which is like shorter term ratios. Now, we talk about the whole structure of capital in the company, how it is structured, what we could take as a knowledge from that, and as well how risky the company is to go bankrupt. We have to know. You have the whole list of these ratios. I must say that the first one is by far the most important, and we will concentrate on that. Possibly we will say something else about the rest, but not much. I will just mention, please look now in the corner, that obviously I use the book that is recommended for this subject, Hillier and others. Actually, this book is known in the world normally as Westerfield and Ross, or Ross Westerfield, like this, Ross Westerfield. Because these two have written the book at the beginning, and then this guy take over. All right. So in my book, I have my notes here, so just don't worry. I regret a lot that ratio analysis is approached so shortly in this book. It should be much longer, as I explain, at least. And you have here current ratio and the quick ratio, and then he says something about this one that we are now going to talk. He calls it differently, but as well he says something about times interest earned, which is here. So because there was some kind of pressure, you have to learn something outside of the lectures. So please, time interest earned, so-called TIE, please take from the book, as well cash coverage from the book. I call it debt coverage ratio, but it's other way around, the same thing. So cash coverage, okay? And now we will concentrate on our ratios, because we will come to one of the most important. I cannot say how important this one is. It's called debt to equity ratio, or in short, D ratio, and as well in a slightly, you could see, different variation, it's called gearing, but it shows the same. Just the figure will be different and the logic is different, but the result is the same. So, what is debt to equity ratio? Are total liabilities to total stockholders' equity. You remember, maybe I will come back to where it was here. Look, for this ratio we forgot about the left side. We are interested in the right side. So this debt to equity is all what is in liabilities divided by all what is in equity. Fine? So this is this ratio. And as I said, it's such an important ratio. A slightly different concept is it's called gearing. It's like we put the debt as a proportion to the whole right side of our balance sheet, like to the total of debt and equity. But let's concentrate on DE ratio. And as it's explained, shows the relation between the portion of funds, assets, provided by the creditors and the portion of funds or assets provided by stockholders. You know, what you borrowed to what you put into the company. This is the whole concept. As easy as this and as important as this. You compare what the company borrowed with what the company was funded by owners. This is the idea. And of course is a long-term solvency ratios because it indicates the soundness of a long-term financial policies of the company. So debt to equity. Now, when I explain this in detail, debt is borrowed money used within the business. This is the idea. And includes all borrowed money. Long-term, short-term, it may include all variation of as well account payable. You know, just what is considered to be a debt, something that you owe. And equity is shareholders' funds made up of all the share capital plus any reserves. It may be any reserves as well. And as well, so it includes all ordinary share capital and all reserves. Very important when we talk about this ratio, debt to equity, is the nature of the business. Because there might be some businesses that by nature are sort of debt financed. And there are many researchers, and researchers found that if catering companies, those who, you know, go with food for some kind of events, they seem to be almost completely financed by debt because they have the prepayments and so on. But at the same time, they are almost in normal circumstances, not at COVID, coronavirus and stuff, but in normal circumstances, they are normally guaranteed cash flow because every event they are paid. So they are prepaid, they paid immediately, so it's almost run completely on debt. So therefore, this sort of debt to equity ratio or gearing would be not enough to analyze the company. Yes, we have to think equity, debt, how much? So how much? So there's a definition that if it's less than 1, it indicates that portion of assets provided by stockholders is greater than the portion of assets provided by creditors. And that equity ratio more than 1 indicates that this portion of assets provided by creditors is greater than the portion of assets provided by stockholders. So 1 would be equal. Creditors usually like a low debt to equity ratio because the low ratio below 1 is the indicator of protection of their money because the equity somehow, we could say, covers the debt. So if you are interested in how the debt is covered, it's covered by equity. And of course, as I said, this debt equity ratio may sort of vary from industry to industry. And you have to remember that every industry, every branch of the business, every sort of activity has its more or less acceptable rate of debt to equity. And what is good for one business, one industry activity, it's not necessarily good for another one. And normally 1 is considered to be satisfactory. Not more than 1 generally, because it means that all debt is covered by equity. Then we have this description. The ratio is the most closely watched obviously by creditors and investors who might buy the company, because this shows to what extent the company, the management of the company, is willing to fund its operation with debt and not equity, because you need to have some courage to take some debt in order to operate. And for lenders, they are particularly concerned about this ratio, because if it's too much, then every next portion of the loan is at the higher risk. This example, debt to equity ratio. And we have this example. Look, this is a very nice case. We have the company called Conmo, cell phone company, and they have a lot of debt already because they have plenty of debt. And because they have this debt, covenant means the guarantees, more or less. So they cannot exceed this debt to equity ratio of 1.5. Like this is they cannot, because the existing lenders, they say no, it's impossible because our loan that we gave to you will be at risk. But this Conmo company has a very good deal to do. They might buy a rival company. It will cost 55 million. It's quite a lot, but the existing equity level is of 182 million. It's quite okay, but the outstanding debt now is 243 million. So the question is simple. When they try to take a loan with which they would buy this rival company, 55 million, will they exceed this level of debt to equity ratio of 1.5 or not? Please make some calculations. And I provided you with this nice table to fill up. This would not take too much time because everything is here. Outstanding debt plus required debt divided by existing equity. Figure. So it makes our total debt to our total equity, and it gives our debt to equity ratio in number or in percentage, and it is how much? Yes, it's like this. Because we take this debt, existing debt, then required debt, because it will make it our debt, I mean the debt of the Conmo company higher, and we divide it by existing equity, so this total debt to total new supposed debt to total equity is 1.64. And so the debt to equity ratio resulting from this deal will exceed this covenant level. So either Conmo must renegotiate this level to make it higher, or complete this acquisition with some kind of equity raise. So you could see in this case the new debt to equity ratio will be higher than required by lenders. Then cautions. Well, we have always cautions that actually it may alternatively be useful to consider calculating debt to equity ratio for several years in the future, because it would be interesting to see which is the relation exactly in the debt between the interest and the principal payments, because what is paid when, and to find this relationship for each year in future. And as well, the reason for this approach is that even if there is a large amount of total debt in the balance sheet, it may not show the real picture of this company, ability to pay its debt, because it may happen that this debt is to be paid in a quite a long-term future. So still they have the debt, but it doesn't play any important role in the current behavior of the company, because this debt will have to be paid later. And then again, even if this ratio may be good, I mean there is low debt to equity, But when you read the documents, and you will see that quite a lot of debt is going to be paid in near term, then as well it's bad for the company. So yes, there are some cautions that we have to remember. The next one, it's funded capital ratio. This looks like this. Stockholders' equity plus long-term debt divided by fixed assets. So generally, what's the idea of this ratio? It shows that obviously company has some fixed assets. Depending on industry, they are more important or less important. Like in case of a steelwork or shipyard, fixed assets are enormous. But in case of tourist office, probably they will be small or negligible even. So, but generally in some kind of industries, they are very important. And let's imagine a shipyard, that shipyard, the place that builds ships, that stockholders' equity and long-term debt, how nicely they cover these fixed assets. And this ratio shows this proportion of fixed assets that are being funded by long-term funding. And it's defined as long-term debt and stockholders' equity. That is, company has it for a long time, and how this money for a long time covers fixed assets. And then if the ratio is less than 1 or 100%, then it means the most likely that the company finance their fixed assets with short-term debt, which is not very good for the company. And as well, it may be difficult for the company to manage the financing of fixed assets if it's on short-term debt at very high interest rates. This would be a difficult situation. So we have to be cautious. Maybe because we are now close to the end, we have this example that we have the company that operated on a shoestring, means on very low amount of capital for many years, and they having financed its rope making equipment with short-term loans from relatives and credit cards providers. Then there is a new manager for chief financial officer, and he wants to find how this fixed assets, this capital, how it's financed by this short-term financing. Right. So we calculate this stockholders' equity plus long-term debt on fixed assets, funded capital ratio. We fund it with these figures. The company's stockholders' equity is 128, its long-term debt is 30, and it has 311,000 in next fixed assets. So now, please do the calculations. I have nicely provided you with the table almost to fill in. Stockholders' equity plus long-term debt divided by fixed assets. So it's long-term funding divided by fixed assets. And how much is that? This is the ratio, or in percentage. So it's a number or percentage. And we do this calculation and we find that this long-term funding funds only 51% of fixed assets. So inevitably, there is a long-term financing required for the company. Inevitably. So, as in this example, quite sophisticated, CFO promptly arranges 10-year capital leases for the existing company. Very important notes are here, but because it looks like we are running out of time and still we need to talk, so thank you very much for listening and watching. 感谢您的收听和观看。I don't know how to say it. You will tell me how. So thank you. As I said, I strongly believe in ratio analysis, but as well there is a number of limitations or comments or conclusions. So firstly, if the data from financial accounting, from financial statement is incorrect, the whole analysis will be incorrect. As simple as that. So we have to trust the accounting information. Like we are investors, so it's like publicly made information, or we take information from our accountants. We have to trust them, that it's properly done, and then our analysis could be reliable. Then, because if the data is done by accountant and still, for example, not audited, it as well could be some misinterpretation of ratio analysis. I warned you once that a single ratio does not give the whole picture. There must be a couple of ratios from different perspectives, from different groups to analyze the company. Because a single ratio, okay, gives a first glance, but not will be the answer if this investment is a good one or not, if we are investors. And then there's one important thing that we mentioned sort of slightly, that we use this analysis in consecutive years from the past. So as such, we deal only with historical data. We just do not touch future at all. We don't say about expectations, forecasts. Of course, you could do the analysis of the forecasts as well, of course, but they are only forecasts, only predictions. So what we do is the historical analysis, historical data. And if we do the future predictions, it's based on the past performance. And we never know if the past performance was the good one enough for the future, or maybe it was exceptional, it will never be again like this. You never know. You have to use your own thinking in interpretation. Again, if we do like long-term analysis and we have some trends, if there are strong variations of the price level of certain goods and products, this is, for example, like in copper mining industry. They dig copper normally, substantially, all the time. Like they have the assets, they have the copper mine, and they dig it, they sell it. There is a demand, but price of copper goes up and down. So as well, the rentability ratios, for example, they will be all different and possibly distorted. It's again very important to underline that if we compare year after year in one company, we have to know that the accounting principles and policies are the same. As well, if you compare the data from different companies, you must be sure that their accounting principles, policies, laws, regulations are the same. Because if you do not do it, then the comparison is not clear. And this is very important. When we do this analysis of ratios, we never know if there was a special event, special catastrophe, or special winning, or special insurance be paid. Plenty of things like that. There is as well leasing that is off balance sheet. There's plenty of things that you have to put into full analysis of the company. As I mentioned, the copper industry, when you do the ratio analysis of a certain company within certain industry, then it's very useful to have the knowledge about this particular industry, how it operates, what is important. Maybe they have sometimes much longer periods than 1 year of investment, of return. And you have to be an expert. I mean, if you give the ratio to somebody who does not understand this, but you are the experts, you are outstanding students. So brief summary of what we have done with ratios. Brief, just in a bullet. That ratio analysis is an activity that uses financial information to help managers to run the company. Yes, these are the indications. These are just some figures, just some numbers. And when you know how to interpret them, you know basically how to run the company. And because we use the data from the financial statements, and we use basically balance sheet and profit and loss account, and we know that the balance sheet is a proper picture of the company, like a photograph, but only on one point of time, on a yearly basis, the most likely. So we have to remember again that something might have happened in between these dates. Quite a lot of things happen, but we have to judge which of them are normal operating business of the company and which of them are exceptional. And as such, we have to treat them exceptionally to take it in account how we interpret ratios. But if we, on sort of daily basis, daily maybe not, but sort of on regular basis, we are analysts, say, in an investment company, and we, on current basis, we analyze companies, and many companies, many companies, even from the same industry. It's a wonderful tool to effectively analyze and quickly analyze companies, because you just do the number and then you know how to interpret the number. And again, as we noticed, we mentioned there's variations of the ratios and weighted average concept of ratios, that we have to be sure that we prudently use them in consistent way according to the industry and according to businesses. You really need to know when to use the weighted average and when not, or if you have the subtleties in variations, why you use certain variation, what for. And the final word is that, when you analyze the company, we use just balance sheet and the profit and loss account. But there may be many other things, like investing in new areas, new businesses, new countries, changes in management, changes in ownership, technological changes of the product. We have to analyze everything else as well. Overall economic analysis of the company and of the industry.